Welcome to our presentation of executive compensation. An ounce of prevention does beat a pound of cure. We're very glad you could join us today. To dispense with some of our legal, I do have to advise you that the material appearing in this presentation is for informational purposes only. It's not legal or accounting advice. And while it may have been prepared by professionals, it should not substitute for professional services. If you do require legal, accounting, or other professional advice, please seek the services of a professional. Thank you. Today's webcast is going to be using the services of polling questions. Your lines have been muted, so you're not able to ask questions that way, but we very much would like for you to participate. So if you have a specific question throughout the presentation, please, I'm sorry, I'm getting ahead of myself. So you're going to be asked a series of polling questions. Please select the circle button, the radial button next to the best answer. You'll be presented with approximately 4 to 5 questions, which you will need to answer 75% of to receive the CPE for today. Your line, as I mentioned before, has been muted, but we do want you to participate, so please don't hesitate to ask a question. To do so, use the Q&A feature at the very top of your screen. See, it's highlighted in red there. Type in your question, hit enter or ask, and we'll be monitoring those questions as we progress. There are currently no handouts for today's webcast, and we are offering, upon completion of attendance of the webcast, 1 CPE credit in the auditing governmental field of study. To be eligible, you need to log in with your full name, attend for the duration, so 50 minutes at least, and respond to at least 75% of the presented polling questions. We will award your CPE within 3 business days of the conclusion of the webcast. Presenting today is Jeff Witt. Jeff is a manager in the Moss Adams Federal Contracting Risk Management practice, and he brings over 17 years of relevant experience. Prior to his current employment with Moss Adams, Jeff was a controller for a government contractor for 2 years, where he led the implementation and control of compliance systems for government contracting. Jeff also served as a government auditor for the Defense Contract Audit Agency for 10 years. Joining Jeff is Kerry Porter. Kerry is a senior associate in Moss Adams Federal Contracting Risk Management practice, where she focuses on performing business process reviews for clients in various industries. Kerry has completed executive compensation benchmark analysis for a variety of Moss Adams clients. Prior to joining Moss Adams, Kerry served as an auditor for the Government Accountability Office in Washington, D.C., and was the lead staff on the financial reporting and fraud cycles while auditing the Statement of Federal Debt. Welcome.
Thank you very much, and thank you to everyone for joining us this morning, or for some of you it may not be morning. But it looks like we have a good turnout for this webinar, which indicates what we thought, that this is a subject that should be discussed. There's a lot of people that have questions about it. So this is a presentation that is kind of for both nonprofit organizations and also government contractors. They both share certain requirements, even though the requirements are being imposed from entirely different sources on them. In the end, they're both required to do benchmarking, as we will be discussing. So we thank you to both the nonprofits and the government contractors that are joining us today. So we're going to provide an overview of executive compensation requirement for nonprofit organizations. Then we will be discussing an overview of executive compensation benchmarking for government contractors. Then we'll go back and talk more about nonprofits and their risks, and also contractors and their risks, discuss recent court cases surrounding executive compensation, talk about best practices for mitigating compliance risks, and help you to develop a plan going forward. So, starting off with nonprofits. Nonprofit organizations may be subject to IRS procedures designed to assess whether executive compensation is reasonable as compared to data from peer companies. So another term for that is benchmarking. Section 4958 has a rebuttable presumption safe harbor guideline that provides the regulations necessitating a recurring safe harbor analysis. So any nonprofit organization is going to want to perform a reoccurring safe harbor analysis related to their executive compensation, and we'll discuss the reasons why that's important. Additional resources include Resource R503, Checklist C202, and Checklist C203 from the IRS, and we of course have these and understand them and would be happy to provide them to anyone that would need to see those. So, overview of the requirements for nonprofits. So the criteria that the IRS would use to assess compliance of executive compensation levels is based on a number of factors. Partly the benchmarking analysis that we're going to be focusing on today, but there's a number of other requirements for nonprofits. An independent approval of compensation, a conflict of interest policy, compensation arrangements approved in advance, the date and terms of the approval documented in writing. So those are all other areas that are important, but what we're going to focus on for nonprofits today is the comparable compensation information that is compiled from other organizations of comparable size, purpose, and resources for similar services. Section 4958 of the IRS Code defines a disqualified person with respect to any transaction as any person who was in a position to exercise substantial influence over the affairs of an applicable tax-exempt organization. So these are typically the executives of an organization, and so it is defining these executives as disqualified persons because of their ability to exercise substantial influence. And once that definition is determined, those are the people that are then subject to benchmarking for the nonprofit organization. So as far as what the penalties would be for an organization determined by the IRS to have violated the safe harbor rules and to be paying compensation in excess of the benchmarks, and if the organization hasn't done benchmarking, then the IRS is going to do that benchmarking, and they're going to decide after the fact, it could be years later, they're going to decide whether that organization paid excess compensation to the disqualified persons for their organization. And if that is the case, initially a 25% excise tax is assessed to that organization. And if that is not corrected, an additional tax of 200% of the excess benefit will be assessed. And these assessments are to the person that received the excess benefits. And that is very problematic for those persons that may have received those excess benefits for reasons that we'll discuss a little bit more. Also, in addition to the implications to the individual that received the excess benefits per the IRS, an organizational manager that participated in the transaction, knowing that it was an excess benefit transaction, is subject to an excise tax equal to 10% of the excess benefit, up to $20,000 per transaction. And so this is where a lot of the controllers, CFOs, others that are involved in these organizations, where they really start to perk up and listen to this, is that they themselves can be subject to these excise taxes, personally. And how the IRS is going to define a transaction is not always clear. So when it says $20,000 per transaction, the IRS could indicate multiple transactions involved, and that number could be very large for an individual and an organization. So it becomes really important to protect ourselves as we're managing in these organizations, to understand these rules and have performed the safe harbor analysis so that you're in a good position to know you're not at a personal risk as well as your organization's risk.
So let's go to a polling question. If the IRS determines that an excess benefit transaction has been provided to a disqualified person, the IRS can impose which of the following? And as I said earlier, you want to select the radial button next to the best answer. That a 25% excise tax, a 200% excise tax, possibly both excise taxes, or none of the above. We'll give it just another few seconds and we'll close the polls, give everyone a chance to enter their answer. And the polls are closed. And it looks like we had both excise taxes, and that is true, although a 25% excise tax and a 200% excise tax are not wrong. It just depends, I think, on if you make the adjustments and the corrections that they're looking for. Is that right, Jeff?
Yeah, that is right. You can avoid any excise tax, as we'll discuss in a second here, but yeah, there is a potential for both of those excise taxes to be applied. So how do you avoid, assuming that you haven't done the safe harbor analysis, you don't have the benchmark data, and it's determined by the IRS that you paid excess compensation, how do you avoid paying these kind of penalties and having the reputation of your organization diminished? And the way to do that is through correction. And an excess benefit transaction to a disqualified person is corrected by undoing the excess benefit to the extent possible and taking any additional measures necessary to place the applicable tax-exempt organization involved in a position that is not worse than that in which it would be if the disqualified person were dealing under the highest fiduciary standards. So what that basically means is you have to unravel this whole transaction or transactions. The problem with that is that it may be years after the actual events when the IRS does an audit, determines excess payments, and so it's very difficult to unravel something like that at that point. You would have to go back to the person that received the money, see if they would be willing to repay it to the organization, and then consider all of the tax implications of that. So obviously not a good situation for either the organization or the individuals involved. So while there is the ability to correct and avoid the excise taxes, it can be almost impossible to do that. And that assumes that the person receiving the money, who is now being told 3 years after the event that they were paid excess salary, that they have to pay that back, and that's not an easy discussion. So also, interest is computed for the period from when the excess benefit transaction occurred to the date of correction. So with that, we're going to switch gears a little bit at this point, and we're going to start talking about the rules that would apply to government contractors. Later on, we'll talk more about nonprofits, but Kerry's going to discuss the implications for government contractors.
Yep, thanks, Jeff. For government contractors, we're going to focus on two main regulations. There's going to be the compensation cap and then the reasonable requirement. So keep that in mind when we're going forward here. And first, we're going to talk about who is considered an executive. According to the DCAA Contract Audit Manual, executives include anyone with the title of vice president or above. So not just the executives in the C-suite, and it kind of goes beyond what you and I would consider our traditional executives. The Contract Audit Manual goes on to say this normally includes individuals responsible for these primary functional areas. So the executive office, of course, the head of accounting or the controller, head of general counsel, maybe your director of engineering, director of manufacturing, head of purchasing, contract administrators, or individuals responsible for major programs or product lines.
One thing I wanted to mention at this point is we're going to be citing the Contract Audit Manual, and we have in the past. We just want to make it clear that the Contract Audit Manual is not a regulation. It's not it doesn't define the rules that you're subject to, but we think it is important that as a government contractor you know what they're going to do when they come and perform an audit. And so to the extent that you can align with their definitions, you're usually better off.
Mm-hmm. Okay, moving forward here, we're going to look at what does compensation include. So compensation is defined by the FAR as the total amount of salaries, bonuses, deferred compensation, and employer contributions to defined contribution plans for the fiscal year, whether paid, earned, or otherwise accruing, as recorded in the cost accounting record. So this is in the Federal Acquisition Regulation, which is considered a regulation. Basically what this paragraph boils down to is any sort of base salaries plus any cash bonuses paid during the year. And then you have to add in the non-cash awards, so things like stock options or stock awards, and then any other long-term incentives. Okay. Now the first requirement here for contractors is the compensation cap. Compensation caps only apply to the 5 most highly compensated employees in management positions. So that's important to remember when going forward with your analysis. Section 39 of the Office of Federal Procurement Policy Act caps the allowability of compensation costs for senior executives of government contractors. The maximum amounts are published annually in the Federal Register, and it's important to note that compensation caps doesn't limit the amount you can pay an executive, but it does limit the amount that can be charged to government contractors. So it kind of defines the allowability for executive compensation when it comes to government contracts. On the next slide here, we can look at the published compensation caps thus far. And this note on the side, it says even if executive compensation is below this cap, contractors are still subject to reasonableness requirements, which we'll talk about a little bit later.
Before you move on this one, I just thought I'd mention that, we've been helping a lot of government contractors with when the DCA does come out and visit them. And we've seen where DCA just misapplies its compensation cap. They're just absolutely using the wrong numbers. And it's a little bit more complicated than it may appear in terms of how you prorate the cap for the applicable periods of time involved. And so it's just interesting to us that we have seen DCA not apply this cap correctly, so we're always looking for that.
Mm-hmm. Yeah, the caps are on a calendar year, so if you're a government contractor that operates on the federal fiscal year, you may need to adjust this cap than what's reported. Also, I wanted to note there's some controversy going forward. As you notice, the data in this chart only goes to 2011, and I can promise you that's the most recent data. The Obama administration's been really pushing to lower this cap. It might go as low as the vice president's salary, which would be like $230,000, or the president's salary, which is $400,000. There's legislation kind of pending on both fronts, so we'll have to keep an eye on where that goes. Moving on to the next regulation here is the regulation for reasonable compensation. Oh, just kidding.
Let's
polling question.
Yes, perfect. Thank you so much, Kerry. I promise to be brief. So the Office of Federal Procurement Policy, Executive Compensation Cap, and the FAR reasonableness requirements apply to which of the following executives? Is it only the top 5 highest paid executives for both of those? The top 5 highest paid executives for the cap and all executives for reasonableness? Or all executives for the cap and only the top 5 highest paid executives for reasonableness? Or everyone at the company for both? This is a great question. And I think we'll go ahead and we'll close the polls. Hopefully we've got everybody in there. Okay. And Kerry, do you want to speak to this?
Yes. The correct answer is B. So the compensation cap does apply to only the top 5 highest paid executives, but the reasonableness requirement will apply to all executives. Looks like that was kind of a trick question. Yep.
It looks like most people got it right, too. So.
Yeah, they did. Okay. So now we're going to move on to the reasonableness requirement. So back to the FAR 31. It provides that compensation is reasonable if the aggregate of each measurable and allowable element sums to a reasonable total. So that guidance isn't completely clear, so luckily we have some other things to look at. The FAR goes on to mention that there are some factors the DCA may consider when assessing reasonableness. It looks at firms of the same size, in the same industry, same geographic area, and engaged in similar non-government work. So once again, these are factors the DCA will take into consideration when determining what is reasonable and what is not.
I have another polling question. So according to the FAR, which of the following factors are considered relevant when assessing reasonableness? Is it industry, geography, size of the company, or all of the above? Give it just another few seconds, let people finish registering their answers. And we'll go ahead and close those polls.
And the correct answer is D, all of the above. Those are the set forth by FAR 31, and we just mentioned those on the previous slide. And kind of moving forward with the reasonableness requirement here. Because the guidance is a bit hazy, we recommend obtaining a benchmark analysis, but we're going to talk about that later. So concerning executives, this generally requires that each executive's compensation be supported by sufficient benchmark data, which should address the reasonableness requirement. Regulations do not specify what constitutes adequate benchmark data or how the data should be applied when assessing reasonableness. And once again, we go back to the Defense Contract Audit Manual, which, again, it's not really regulation, it's more procedural guidance for the government auditors. But it kind of provides more guidance for our reasonableness requirement. However, there's been several court cases which have successfully challenged this DCAA methodology. And we'll be talking about that a bit later, too. So moving back to nonprofits with Jeff, he's going to talk about some of the risks that are...
Yeah. So with regards to nonprofits, the level of penalty depends on the nature of the violation. So first of all, there can be the determination that there's been a safe harbor guideline violation. There's also probably one of the bigger impacts to any nonprofit organization is the reputation impairment. If you are a publicly supported charity or other operating foundation or private operating foundation, whichever the case it may be, generally your reputation is key. And if there's impairment of that because the word is out that you've overpaid executives or you're not being good stewards of the money that you've been given, then that may be your biggest risk. Assessment of 25% tax, we talked about the correction action that would be required if it was even possible. For federal income tax purposes, the disqualified person may not deduct as a charitable contribution any portion of the correction payment made to the organization. So if it is unwound through having the person repay the excess amount, then the person is still kind of has a negative impact. They're not allowed to deduct that payment as a charitable contribution, just to clarify that. And then the worst, one of the worst scenarios is nonprofit status revocation if the government were to be of the opinion that it was really pervasive and intentional breach of their requirements. So as far as risks for contractors, sorry to be switching gears back and forth from you. Hopefully we're not making you dizzy. But almost every government contractor over $100,000 in value, except for acquisitions of commercial items, contains a contract clause granting audit access to the government. So the government is going to have the ability to look at this. Even if it's a fixed price contract, you have some risk related to this, because if at the time you negotiated that firm fixed price agreement, you provided them information about your indirect costs that included executive compensation, and you didn't have an adjustment for the amount that would be unreasonable, then there is a case for defective pricing there. But certainly on cost type contracts as well, there is this ability for the government to come in, and it could be 4 or 5 years later, because DCA is way behind, or it could even be more than that. They will do an executive compensation review, and it may be part of an annual incurred cost audit, but it may also be conducted as a separate assignment. This is one of DCA's top issues, and it's the one that they get the highest payback for typically. So that may be the only thing that they do for your organization, is this executive compensation analysis. It's a very low-hanging fruit for them. Contractors with a significant percentage of work in flexibly priced government contracts may want to prepare to undergo an executive compensation review. So we're just saying that you want to be prepared for that eventuality if you're a government contractor. And as far as flexibly priced, we're talking about cost-type contracts, but also T&M contracts, and there is also risk related to firm fixed-price contracts, as we mentioned, because of the inclusion of the defective pricing clause in those contracts. Also, compensation to owners of closely held corporations may be at a higher risk for audit because of the non-arm's length nature of those transactions. The government believes that there's much higher potential for abuse in that situation, because there's no one looking over the shoulder necessarily of the executive. There may be a board in place that has some oversight of that, but there may not. So it may be that there's executives in these organizations that have the ability to set their own compensation, essentially. And that's the risk area for the government, and that's what they're going to be looking for. Contractors may find their executive compensation charges challenged to be subject to penalties, and in some instances result in a DCA system deficiency determination, which is probably one of the worst case scenarios for you, because it not only, obviously they're going to question the cost, but they're also going to issue to your contracting officer a system deficiency report, which can then preclude you from possibly future work until the situation has been remediated, and may limit your ability to bill on your current work in certain scenarios. So obviously that's pretty significant impact. I wanted to talk about some recent court cases that have really been helpful to contractors in the ability to push back with DCAA. DCAA, basically they have a compensation team that's in the Mid-Atlantic region that performs these executive compensation reviews for all of DCAA, for all of the United States essentially, or even around the world. So this executive compensation team has a methodology that includes applying a 10% range of reasonableness allowance and some other methods that have been successfully challenged. Unfortunately, while these contractors were successful and their efforts have helped all other contractors, they still had to go through years of court cases to get to this point and be successful. So with the J.F. Taylor case, they challenged the results of the DCA executive compensation review that was done on them. They question the statistical validity of the review methodology, especially the 10% range of reasonableness allowance. And the ASDCA ruled that the methodology used by DCA was fatally flawed statistically and therefore unreasonable. So, for example, the use of just a 10% range of reasonableness is not statistically valid. I think most of us could come to that conclusion if you've taken any statistics that that's not statistical. And so the interesting thing, though, is even after this case, DCA still continues to use this 10% range of reasonableness approach. Every time we've seen them do their calculation, they do it this way. So they have, I guess, unfortunately, considered this result to be an isolated incident and haven't really taken to adjusting their methodology as a result of this.
Right. In this case, actually, the board stated that J.F. Taylor used up to the 75th percentile to benchmark their executives to, and the board said that was reasonable because that was a statistical calculation.
Absolutely. So now on to the Metron case. Similar to the previous case with a similar result, that they question whether the DCA had used executive compensation surveys appropriately also. This provides a precedent that factors other than revenue should determine an appropriate compensation level. So if DCA is using a benchmark that is only considering revenue and not other factors, then that is, I think most of us could see why that could be a fatally flawed approach. It demonstrates the importance of a strong executive compensation plan. Certainly neither J.F. Taylor nor Metron would have been successful if they hadn't done their homework, if they hadn't done good benchmarking, and they didn't have a strong executive compensation plan. So and that's, I think, why these two companies decided to fight it and take it as far as they did, and which is good for the whole industry. The board determined that all of the costs in dispute were allowable, sided with Metron.
Mm-hmm.
So, again, they were only successful because they had done their homework. They not only had the benchmarking, they also had the documentation. They had policies and procedures which aligned with this, and these are all things that any company that it would have hopes of challenging DCA should consider.
Yeah. Also, considering the surveys, so DCAA uses a methodology where it uses multiple benchmarking surveys. So in this case, in Metron, they were using 5 different surveys and averaging the results. Even though one survey really provided the best results for Metron, it had better matches concerning industry and geographic location, so that was a better match for Metron, and that's what Metron used. So that was one of the big things that came out of this case is, the board said you can use this one survey because it's more relevant to your company.
Absolutely. So I think at this point, Kerry is going to talk to us about best practices for mitigating risk.
Mm-hmm. Yep, so we've come up with a couple best practices through what we've seen in our work. The first is develop a robust policy and procedure supporting your compensation packages. We just discussed this in the Metron case, and it was a big factor in the board's decision. So we suggest that your company documents any circumstances that may affect compensation decisions. For example, if compensation is set by a committee, document meetings with detailed meeting minutes and what's decided and how it's decided. The policy should also contain a management-approved plan which details the structure for both compensation and bonuses. For example, if your company implements performance-based compensation, make sure you lay out the specific criteria or formulas used in making those compensation decisions. The goal here is to make it pretty transparent before the auditors come in so they see that you've established these policies and procedures and you're not really just straying and paying executives more than they should be. So the next best practice is documenting performance of the company relative to industry competition. This is also another factor that came up in those court cases that we mentioned. So contractors may be able to justify paying your executives more if you can document superior performance within your industry. This is actually an issue in both cases, the J.F. Taylor and the Metron case. And the board did allow both companies to pay up to the 75th percentile because they were able to document superior performance in their industry. The contract audit manual actually provides a little bit of guidance in this area in what the DCA may consider when trying to measure superior performance. There's things like revenue growth, return on shareholders' equity, return on capital, market share, net income, return on assets, earnings per share, cost savings. Again, it's important, you could include these things into policies and procedures, which is from our first best practice, and this on how it may affect compensation package. For example, if you have a certain amount of sales, you may get rewarded in your bonus or your annual bonus, that sort of thing. Once again, it makes it a little bit less subjective.
Time for another polling question. So, which of the following is not highlighted by the CAM as an indicator of superior financial performance? Which one is not highlighted by the CAM? I think another way to say that is which way is what is the CAM not going to look at when identifying superior financial performance? This is a good question. We'll give it just another few seconds and we'll close the polls. I think we have everyone accounted for. And we'll go ahead and we'll close the polls.
So the correct answer on this, well, I guess it's actually the incorrect answer, is stock price. The CAM does not highlight this. They do highlight earnings per share, but not stock price. So all the other ones, return on assets, net income, and cost savings are all included in there as indicators of superior performance. So moving forward to our third best practice here, we're going to highlight is obtaining an executive compensation benchmark analysis to support your compensation decisions. And this is really applicable to both contractors and nonprofits. Once again, you want to ensure this analysis factors in the variables such as size of the company, geographic area, statistically valid ranges. Like we said before, don't just apply 10% as it may not be a statistical method. Also include executive job descriptions, the industry, recent performance of the company, and we like to benchmark both median salaries as well as bonuses and other long-term incentives. Once again, you can use this analysis to document superior performance by including relevant ranges of compensation, so showing both the median and the 75th percentile. If you think these factors that we've just mentioned look kind of familiar, they're from the FAR 31 as factors that the DCA does look to determine reasonableness. So we want to kind of keep that in line with the regulation. So expanding a little bit more on the executive compensation benchmark analysis, we've had some experience in performing this analysis for several of our clients. And we chose to use the Economic Research Institute Executive Compensation Assessor and Salary Assessor software to provide these benchmarking analysis. We found that this is kind of the best software for the needs of our clients, and it happens to be one of the surveys that DCAA also relies on. So for public companies, we provide benchmark analysis based on annually reported SEC proxy data. This is the annual report that goes on the SEC EDGAR website. And it provides a lot of data for us to use, which makes it a little bit more statistically sound. For non-public companies, we have to kind of customize the analysis to benchmark both base salaries and bonuses to companies of similar size. So again, we look at revenue growth, industry, location, that sort of thing.
Yeah, and I think one thing from our experience is, especially for public companies, be especially leery of the DCA benchmark and whether they have actually used a benchmark that is coming from proxy data and does include total compensation, including stock options and awards, because we've seen where they at times may use salary surveys that don't necessarily include that. And if you are a publicly traded company and you have costs like that, you would want to really have an apples to apples comparison so that you're really benchmarking correctly.
Mm-hmm. Yep, that's important. You don't want the DCA trying to lowball you here. So one of the common hurdles we've encountered when performing these analyses is maintaining the statistical validity of the analysis. As mentioned in those court cases, this is it's a huge factor when trying to contest the DCAA. Sometimes it's difficult to find comparable companies, which may impact the validity of the analysis. So we like to ensure that there's adequate population size, which the software we have allows us to look at how many employees were surveyed and how many comparable companies it's using. So some remedies we've came up with for this problem is using a more general industry. For example, if your company manufactures like a very specific component for some sort of medical device, if you kind of bump that back up to medical device manufacturing, it's like a more general industry, that can definitely help. You have to make sure that that industry is still very applicable to your company. Also, expanding the geographic location. We like to start with the city. Sometimes if it's a major city, there'll be adequate data, and then move it back up to the state and sometimes the national level if need be. Another hurdle we've encountered is aligning job descriptions to benchmark data. This is also a little bit more of a creative issue and has also been challenged in court. So obviously not every company has the same organizational structure, and it's sometimes hard to match that organizational structure to the data that is in the benchmarking software. A lot of times executive positions are dependent on the needs of the company, as they should be. So some remedies we've developed is going beyond just the job titles. We like to look at the job descriptions and even interview the executives and see how much time is dedicated to each responsibility of the job. And it goes back to how important it is to maintain accurate job descriptions.
Yeah, I guess I'd add at this point, this is what makes or breaks the analysis. This is the key, and this is what takes the experience to really do this part correctly. I mean, if you're, you've got a CEO and you're benchmarking to a CEO, that isn't too difficult in some cases, although even that, depending upon what that CEO's roles are, that may not be the correct benchmark for them. So it's really important for each of these executives, first of all, define which are the executives for your company, and then you go through all the hard work of really assessing what they do and coming up with the right benchmark for that scope of work.
Mm-hmm. Yep, and our database in particular allows for creation of hybrid positions, which we've had a lot of success with. So we're able to kind of weight the roles based on the actual responsibilities, so combining different job descriptions in the software in order to come up with the most accurate benchmark data. And in the Metron case, this was actually a big issue. Metron compensated its senior engineers as executives and obviously the title senior engineer doesn't really indicate an executive position, but in their case it was. And they use, based on their experience or compensation levels, you could tell they were actually executives of the company and their responsibilities. So the DCAA was benchmarking them to just senior engineers, which obviously were not very comparable to, executive compensation levels. So this was one of the points that was overturned by the board, and Metron did have success in fighting this decision.
You know, Kerry, I'd like to ask a question. Peggy asked, and this I think fits appropriately right here. So if they have a scientist or an engineer that makes more than a VP, do they come into the top 5?
Well,
do they have to benchmark to that position?
It may be, it's not necessarily just because they make more that they're considered an executive. They still could be excluded from being an executive. It depends on what their scope is, responsibility of the company. And that's kind of the art of the analysis is understanding how to apply that. And, you know, again, we don't have a regulation that really defines that for us. We do have DCA CAM, and we have some other sources that help, but that is always the challenge.
Okay, thank you. So now we have our 5th and final polling question. So when considering executive compensation, which of the following are considered best practices for mitigating risks? Do you want to be setting executive compensation by an independent compensation committee, by obtaining an executive compensation benchmark analysis, by documenting both the performance of the company and the performance of individuals within the company, or all of the above? And we'll give it just another few seconds. Everybody, please be sure and log in your answers if you're wishing to receive CPE. And we'll go ahead and close the polls.
The correct answer here is D, all of the above, although, you know, we understand that companies are of different sizes and organizational structures, and not everybody can have an independent compensation committee or things like that. So that's important to understand. Now, going forward with this issue, as we've mentioned several times, this is an area that's gaining visibility, and contractors can expect executive compensation reviews on a more regular basis. Also, it's important for the nonprofits to remember that they are a part of this as well. There's a lot of future legislation out there that suggests there might be more regulation. The compensation cap may be expanded to cover all employees of the contractor. That's kind of in the works as well. And as we mentioned, the recent proposals indicate that the compensation cap may be lowered in the future. You know, with tight government budgets, there's a huge push on cutting, you know, waste, whatever that may be considered. So they're trying to really cut back on costs. So the bottom line is contractors and nonprofits should take proactive steps to align your company policies and procedures with executive compensation regulations. This may help prevent unfavorable reviews later.
Yes, and I'd say the goals for whether you're a nonprofit or a government contractor essentially the same. You don't want to be in the situation of having to deal with either the IRS or the DCA and having a disagreement with them. It's much better to avoid that. Even though we saw some companies that were very successful at winning their cases, it's still not something most companies are going to want to go through. So you're going to want to be prepared before the auditors arrive, whether they be DCA or IRS. Have that benchmarking analysis done, have the other steps taken and the documentation done so that you can just provide that to them and have a smooth audit. You want to avoid any litigation by taking those steps, and that's really our recommendation to everyone, even though we know that DCA, for example, continues to use an approach that has really not been successful once they get to court. Even so, if you can avoid that whole situation, we think you're much better off. So I think
Yeah, we've just included on the next slide some resources that we've mentioned throughout this presentation for a little bit more light reading if you're interested. And at this time, that's all we have for today, and we'd like to thank you for attending, and we'd be happy to answer any questions if there are any at this time.
We did get a question, Kerry. Gail asks, is it sufficient to cite paragraph 3IA of 52.204-10 to get out of the requirements if a contractor receives less than 80% of its annual gross revenues from federal contracts?
I don't have that memorized. I could tell you that I haven't seen an option for most government contractors based on FAR Part 52 to get out of that. Again, it's going to depend in part upon the type of contract that you have. If you have a fixed price contract, then probably less risk. Your only risk on a fixed price contract is that if you provided cost or pricing data that indicated your indirect rates were a certain rate, and then part of that was your executive compensation cost, and you did not adjust for reasonableness, then you've got that risk on fixed price. But that is a lower risk, I'll grant you. But on cost type contracts or other flexibly priced contracts, there's really, I don't think, a safe harbor for a government contractor to avoid having this benchmark analysis for executive compensation. We'd be happy to take a look at that particular FAR and get back to you, though.
Great. Another question, what exactly is an excessive benefit transaction?
So we're talking about, that's in the context of nonprofits. So excess benefit transactions is when you pay someone that's a disqualified person, so usually an executive of the nonprofit, you pay them in excess of what you can support through your benchmark analysis. That's your excess benefit amount, is the difference between what is supported by the benchmark analysis and what you paid them.
Great. And finally, having not received any additional questions, if you do have questions for our presenters, don't hesitate to reach out to them. Jeff, do you want to wrap up just a bit?
No, we just want to say thank you all for attending. We're very happy that we had the attendance that we did. It's great to have a mix of both nonprofits and government contractors. We would love to answer any questions that either of these groups would have, and please feel free to contact us with the information here on our contact, either I or Kerry.
Thank you. Thank you both.